Stripe mounts blockbuster $53 billion bid to buy PayPal. That single number resets the market's playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. That is what Stripe just offered for PayPal. Not a rumor. Not speculation. A formal bid that reframes the entire fintech market in one move. Let's be clear about what just happened. PayPal has been the dominant player in online payments for 2 decades. Stripe built the infrastructure layer underneath, the plumbing that powers checkout for companies like Amazon, Shopify, and thousands of smaller creators. Now Stripe is saying, we don't just want to power payments, we want to own the consumer-facing platform too. That acquisition would create a fintech monopoly unlike anything we've seen. Here's why this matters immediately. First, the valuation signal. $53 billion tells you something crucial about how the market values payment infrastructure in 2026. That number reflects confidence in recurring revenue, network effects, and the sheer stickiness of PayPal's customer base. Every payment processor and every investor watching this deal is now recalibrating. Payments are not a commodity anymore, they are strategic assets. Companies like Square, Wise, and even traditional banks are watching this bid and asking, what are we worth? What are we worth if someone is willing to pay this much for PayPal's customer relationships? Second, this is about consolidation at the infrastructure layer. For years, fintech was fragmented. You had specialist companies, one for invoicing, one for payroll, one for expense management, one for cross-border transfers. Stripe has been quietly acquiring these players for years. This PayPal bid is the endgame of that strategy. Stripe is trying to own the entire stack, the payment processor, the merchant tools, the consumer wallet, the international infrastructure. That vertical integration changes pricing power. It changes customer switching costs. It changes who gets to extract value from every transaction. Third, there's a counterpoint no one is talking about yet. PayPal's board might reject this. PayPal has activist investors. It has a stock price. It has regulatory obligations. A $53 billion bid sounds enormous until you compare it to PayPal's market cap in 2021. They were worth $85 billion at their peak. The company has been in a slow decline, but the assets are still valuable. PayPal could argue that the bid is low, or that independence with a new CEO is a better play. Or, and this is the scenario markets are gaming out right now, PayPal could accept, and then regulators could kill the deal. Antitrust scrutiny on mega mergers is intense right now, especially in fintech. But here's what changes if the deal happens. First, merchant fees could compress. Stripe and PayPal combined would have such massive scale that they could undercut everyone else on transaction costs. That sounds good for small businesses in India and everywhere else, but it also means less room for competitors like Razorpay, Pine Labs, or Instamojo. Second, innovation on the consumer side accelerates. PayPal's user base is aging. Stripe's tools are developer-focused. A merged entity could build products that are both simple for consumers and powerful for creators. That could steal market share from Square's Cash App and every regional payment app globally. Third, employment changes. Stripe has roughly 10,000 employees. PayPal has about 25,000. A merged company would face pressure to cut 15,000 to 20,000 roles within 2 years to justify the premium. That's real for engineers, customer service reps, and operations teams across the US and India. For investors specifically, if you own fintech stocks, you're now in a waiting game. The deal won't close for 6 to 9 months. In that time, PayPal's stock could spike if the board negotiates a higher price, or crater if regulators signal rejection. Stripe's investors, who are mostly private, are taking a massive bet that this works. If it doesn't, Stripe just burned credibility and cash on a failed acquisition. If it does, they've purchased a consumer-facing moat that took PayPal 2 decades to build. The contrarian view, Stripe might be overpaying. PayPal's growth has slowed. Their user engagement is dropping. Mobile payments have fragmented, everyone uses their bank's app, or Apple Pay, or regional players. Buying PayPal for $53 billion means Stripe is betting it can reverse that decline, cut costs, and unlock growth. That's possible. It's also a big if. What to watch in the next week? First, PayPal's board vote and statement. Second, regulatory signals from the FTC and DOJ. Antitrust concerns will dominate the discussion. Third, moves from Square, Wise, and other fintech players. They're now in a race to consolidate or get acquired themselves before Stripe becomes too big to challenge. Fourth, how payment networks like Visa and MasterCard respond. They're the plumbing layer above everyone else. If Stripe owns merchant checkout and the consumer wallet, Visa's and MasterCard's leverage shrinks. They might lobby hard to kill this deal. This is not just a fintech story. This is about who controls the rails of commerce. Who sets the price? Who sees the data? Who builds the tools? Stripe's bid answers that question with one number, $53 billion, and the market is now repricing every asset in that industry around that answer. Subscribe to Atlas Signal for daily signal on markets, tech, and what changes next. This kind of analysis, the second and third order effects nobody else is connecting, is what we do every day. That's what Stripe just offered for PayPal. An actual bid that reframes fintech forever. Here's why it matters right now. That valuation tells every investor in payments exactly what infrastructure is worth in 2026. Second, this is consolidation at the infrastructure layer. Stripe doesn't just want a power checkout, they want to own the entire stack. Third, if the deal happens, antitrust is the real blocker. Regulators are already skeptical of mega mergers. But if it closes, fintech competition just changed forever.